I'm not interested in investing in good businesses. It is easier to get going than it's ever been, and I think it's harder to make something important. 5-6 years in, a company that is important to me, the founders called me with a real crisis of confidence. I don't know that this is going to work.
Do you think in this AI moment, more pre-AI founders should be having honest conversation with themselves and say, am I really ready for this?
I was on a panel recently with early stage investors, blue chip folks. Someone in the audience asked a question, how to invest in AI companies right now.
Sure.
The first guy said, there's no moat. The only advantage is a distribution advantage. Investor right next to him said, we do the exact opposite of that. Only interested in businesses that we believe have a tech moat. Folks who would look at the same market and be diametrically opposed to one another in terms of what they think is important. This is the Wild West.
What were some dogmatic things that you had to question and unlearn?
I fell into this trap.
Welcome back to Climb by VSC. I'm Jake Kapoor, General Partner of VSC Ventures. So on the show this season, we've been talking about how AI changes how we build and back companies. With my guest today, I wanted to go into the mind of an investor who's been both a founder and now, as an investor, backs founders to see how he's thinking about this changing landscape. My guest today is Ben Lerer, who's managing partner at Lerer Hippeau Ventures, a New York-based seed stage venture firm. He also co-founded Thrillist and later led Group 9 Media, which was acquired by Vox Media. You know, one of the things I'm really excited to talk with Ben about today is how the archetype of an AI native founder has changed. How that changes how he evaluates companies at his firm, what kind of things that they have to unlearn from the last generation of venture. And then how he takes those lessons into building a firm that's going to endure for another 15 years. So Ben, thank you so much for joining me on the show today.
Thank you. I'm very excited to be here.
You know, we were chatting a little bit yesterday when you were coming on about this idea of you're a founder that backs founders. How do you think about this current crop of founders, these AI native founders today? How are they different from the founders that you were coming up with or the kind of founder that you were?
Yeah, great question. And it's something we are talking about a lot. Interestingly, having done this for a long time, I think one of the competitive advantages of having been around and sort of developed a network over the course of, decades working is you sort of have these like long-term embedded relationships with folks who you built trust with and who presumably or hopefully have had long careers and learned a lot. And AI has sort of shaken that system up a little bit in a way that is a little bit new generation of generally very young founders that have grown up this way who like the idea that their teams will be made up of a combination of humans and agents is totally native to them.
Yeah.
And the idea that, they're going to have most of the code reviewed versus written by humans it's something that you can make that pivot as a founder, but I do think that we're finding an advantage for folks who have grown up this way. There's also culturally something that has happened where I think if you've grown up, younger people who have grown up primarily sort of online socially have in some ways sort of different work ethic and different styles. And you see that, we find these founders who are working 80, 90, 100 hours a week. You have this like young group of founders who are like, all they do is work and they work extraordinarily efficiently because of sort of AI at every single possible juncture in how they build a team and how they function. And so you see them moving really fast.
Yeah.
And speed matters so much right now. And maybe putting all that aside, I do think one of the biases that we see in terms of like this AI native founder is just moving fast.
Let's touch on a couple really interesting things you said there. One is about the unlearning, and then the other is about speed and how you test for speed. So let's start with the unlearning a little bit, right? What were some, dogmatic things about company building that you felt so confident in that you've kind of had to question and unlearn today, whether it's about team or it's about product?
I think in terms of team, first of all, and this is maybe like an unlearning for me, is really valuing people with domain expertise. We talked a lot internally, historically, about this idea of fully formed humans, backing people that like have a real right to win. They've been living in a market. They understand the nuances. They're solving a problem that's really personal to them, and almost discounting founders who are sort of solving like a business school case study problem. They're, they see a gap in a market. They're going to go fill that gap. And I think historically there was this perspective, which is why do you have any right to win in that market? What do you know about that
Yeah,
market?
the earned secret, right?
Totally.
As they say, yeah.
And I think now, look, I still believe in that. And I think at some point you will see companies run up against the idea that, like, there's lots of early money to go test AI. Everyone's moving 1,000 miles an hour. And at some point, the enterprise buyer is going to say, hold on a second, am I buying from someone who really understands the nuances of my business?
Yeah.
Once I move out of test budgets and into real long-term procurement, like, this is one of the things that I think everyone has this sort of wait and see, like, oh my God, is all this revenue real vibe
Totally.
in early AI companies? But in a bunch of industries, things are going to be very upended by AI in terms of how even like the traditional companies, the buyers operate.
Yeah.
And so it's unclear if that domain specific knowledge is as important today. And I think in some cases, the idea is back a really technical, very fast moving young founding team, and they'll add that industry specific DNA versus the other way around, which was start with this industry expert and they'll hire the CTO. The market has sort of switched to start with the technical talent and fill in the industry talent. And I, every company's a snowflake and every situation's different. And that doesn't mean that we're not going to back the seasoned person who's solving a problem they really understand. But we have a lot more willingness to lean into a very young, generally unexperienced team today than we have in the past.
I'll challenge the bit about the technical piece a little bit. With so much of code being written by AI, I mean, I play around with Replit. You can do a lot with the base level of, these
and soon
coding
you'll be able to
agents.
do a lot more, right?
And soon exactly 9 months ago, Replit couldn't do what we could do over a weekend today. In that, how much does technical expertise on a team still matter?
So I think that is true, that there will be sort of like democratized, there's already and will be increasingly democratized ability to write code and build product, vibe coding your way and or using tools to take 1x devs and turn them into 10x devs.
Yeah.
I still think there's probably an opportunity for 10x devs to become 100x devs. And that really, really excellent technical talent is going to figure out new and interesting ways to get more bang for the buck and move faster. And so I don't think you take a crappy developer and a brilliant CTO and suddenly put them together and go, when we are looking at 6,000 deals simultaneously. I mean, it is, by the way, top of funnel right now, as I'm sure you see.
Yeah.
It's the craziest it's ever been.
Yeah.
Everybody wants to start a company today.
Yes.
This feels like smart folks have realized that this is, you get one of these opportunities once every 10 years, 15 years, 20 years where you have a real platform shift, a real like foundational breakthrough. And so
does that make you miss it, where you're like, as an operator, man, if I was building Thrillist nights and weekends today, what could I have done?
It doesn't make me miss it. In fact, it is easier to get going than it's ever been, and I think it's harder to make something important than it's ever been.
Elaborate on that.
There's more competition. There is and really cutthroat competition. The quality of founding talent is higher and higher. The celebrification of entrepreneurs in America, I mean, you now look at, or in the world, I mean, like Mark Zuckerberg or Elon Musk are bigger celebrities than the biggest actors or athletes.
Yeah.
That is not a last year change, but this is a last 10 or 15 year cultural shift. But now you have that fully sort of like embedded cultural shift around celebrating entrepreneurship and mixed with a platform shift. Everybody wants to be a founder, and that's scary. Like this is the competition is nuts. The speed is nuts. I really do think this is sort of like a young person's game right now. Granted, I think that anybody who feels like they have their arms around what's going on is very naive or kidding themselves in some way. This is the shape of the thing is changing every day. And look, we're an early stage fund. You're an early stage fund. This is a first principles moment for us around just talent.
Yeah.
Just obsess about people, because if we think we're too clever in a market, or we think we're too clever in predicting like what the large language models will do, in 2 years from now versus 4 years from now relative to what they can do today and what's going to get disrupted, I think we're going to talk ourselves in and out of a lot of like we think we're too clever.
Yeah. What's Anthropic going to replace tomorrow with Claude Cowork, which came out recently, and
there's like huge
makes your head
breakthroughs
spin.
on like it makes your head spin. It really does make your head spin.
Yeah. But on this topic of talent, how do you test that, especially when it's a young person, generationally, maybe a little bit different? Right? I have found the last 4 out of 6 investments I made were all dads about the same age as me with kids about the same age. It just so happened that I understood the phase of life they were in.
Yep.
And so when I'm up at 5 with my kid because he woke me up early and they're up, we associate that way. Talking to a 24-year-old founder today, it's a very different life experience. So how do you evaluate talent and kind of what they prioritize versus what you think it takes to build a lasting company?
Yeah, well, first of all, I think a lot of this has to do with the team that I've built at Lerer Hippeau, which is, I'm a firm believer that if my job is to be the rainmaking investor, then we're screwed. My job is to be the worst investor on the team and to create a culture of winning and to bring in investment talent that is better at this than me and that's younger than me. And granted, I'm 44. Like I am, to be thinking that like I'm on the back 9, maybe, hopefully I'm giving myself a hard time. If you look around at venture, many of like the great venture careers were started after the age that I am currently at. That being said, so I'm not suggesting that I'm like, I don't need to be writing checks, but I do think that my network is going to be less and less of a source of the talent that we are backing.
Yeah.
I think that the team that we're building, which is I think a very strong but also growing team, are building their own networks and their own pockets. The role that I play, I can play a role, I think, in helping to tie back some of the things we see now to some of the history of, pattern recognition and who this person reminds me of, and or who are founders in the portfolio that they need to meet from past generations that could be mentors or that could, play some role in helping us assess them from a technical perspective or whatever it might be.
Yeah.
Obviously helping to win in these competitive situations, playing the card of being a former founder, having done this, having raised a bunch of my own money, been through good times and harder times. I started my business actually very young as well. I started Thrillist when I was in my early 20s. And so sort of having that in common and having those experiences can be valuable. And also, I think very importantly, having worked now with literally in the hundreds of founders over the course of 9 funds, when it comes time to sort of prove our value, there's nothing better than being willing and able to connect a founder to dozens and dozens of past founders that we've worked with and how we've supported them, not only through good times, but I think very importantly through hard times, because that is, as you know, part of the sort of inevitability of building a great company is at some point almost losing said great company.
Yeah. I have learned this about pattern recognition. I used to think pattern recognition was about markets. And I used to think, it's because you understand how a sharing economy company grows or a direct-to-consumer company grows or a SaaS company grows. And in reality, it's actually more about scenarios inside of the company at that time. Hey, I have this issue. I have to prioritize between going deeper with my customer here or potentially widening the aperture to bring on customers from a different segment. When have you seen it work? When have you not seen it work? And
you said, let me introduce you to Sarah and Bill.
Yes.
Both of them have been through this in different versions. One of them looks more like you, one of them did this, one of them screwed it up, and I can get you on the phone with them in the next 3 hours.
That's
and
the value.
They will be full open kimono with you and you're in the fam. And like that, I think, is where the value of the experience comes in. The pattern recognition of you do it enough, the old Malcolm Gladwell 10,000 hour, like you've sat down across the table from enough founders over time. You've seen the arc of those businesses and what's worked and what hasn't and what's gotten halfway there and then fallen over. And it doesn't mean that you are going to be right, but does it mean that you can maybe have a 5 or 10% advantage vis-a-vis someone who hasn't lived that sort of arc? I think so. And,
Well, so you panic less, right? The founder calls you and says, hey, biggest customer, XYZ payment terms, they're not paying. And I think an inexperienced investor, and I had this exact same scenario happen when I was at my last firm, Launch Capital, and then when I was at the fund I'm running, and I remember the second time around, I go, this has happened before, and this is how we dealt with it, and here's how we would have dealt with it differently, and you just panic less. And sometimes I think it's enough that a founder knows that when you call them with bad news, or they call you with bad news, I
that
should
you're
say.
going to handle it the right way.
Yeah, you're
totally.
not going to just flip your shit.
Well, last week I had a company that a company that is important to me. The founders called me with a real crisis of confidence. A real crisis of confidence. 5, 6 years in, I don't know that this is going to work. And this is a company that I don't know if this company, I don't know what will come of this. I'm still very optimistic for a bunch of reasons. And I think I sort of talked them off the cliff a little bit. But what I do know is 2, 3, 4 years from now, independent of that, that will be one of the sort of formative conversations that they had in the company.
Yeah.
And how I behaved in that moment will have a massive impact on the long-term perception that they have about me and Lerer Hippeau. And like you said, the sort of maturity and the patience that comes with having done this for a while, I think can really show up in those moments.
Do you think in this AI moment, more pre-AI founders should be having that honest conversation with themselves and say, is this working? Am I really ready for this? Or am I doing it because I have a obligation to investors? But
and when you say pre-AI, you mean like a company that was built for the last gen and today it's just like
a SaaS business, a marketplace business, whatever. But let me elaborate that a little bit.
I know where you're going though.
It's just like the rules have changed.
Yep.
The rules for how quickly something should grow has changed. And venture, I feel like, is bifurcating into AI native companies that are, basically using inference as their underlying product, but they're zhuzhing it up and selling it and making some margin on it. Or companies that are, I still think, built in the old model, which is maybe serving markets or industries that buy a little bit slower, but real sustainable businesses. That second bucket has a much smaller pool of capital that's interested because everybody's attention is over here. And we can talk about why the incentives of funds make it that the attention is over here. But that's what I'm seeing in the market. I mean, tell me if I'm wrong, but I feel like if you're a founder who's in that second bucket, or maybe a third bucket where you're not even really working in the way that something in the second bucket is, I feel like founders don't sit down enough and actually have a conversation with themselves and with their investors and say, I can either pivot this business to be AI native, or I can't.
Yep. Well, I do think that the second and third buckets are very different, right? I mean, we have companies that are not AI companies, but that are market leading, from 5, 6, 7, 8, 10 years ago in the portfolio. Sure. Real companies, maybe still rule of 40 businesses, profitable businesses, or companies that don't have the need to go raise more money. They're not 150% growers. They're not on the way to being 10 or $20 billion companies, but real companies.
Yeah.
And I think for those companies, there is the decision on like, how much risk do we want to take on with embracing AI? How likely or soon is AI going to come for the space that we're in? Our best founders in those companies are making, I think, the necessary changes to embrace AI without betting the farm. I think that there are other places where things are not working as well. Where those hard conversations are really necessary.
Yeah.
And some have them and some don't.
Yeah.
Some people continue to just smash their head against the wall and always have an excuse for why AI is either not coming for them or inefficient, or their competitors that are doing things AI first don't have as good a product or don't have as good as outcomes or whatever it is, and they're just getting lapped and they're not willing to acknowledge it, and they're not going to build venture scale businesses, and we're pushing them hard to try and like wake them up to that. But there's plenty of folks, particularly people I think that were founded between 2019 and 2021.
Yeah.
That's the core vintage of every single principle and thesis that you had when you founded your business is out the window, and you either acknowledge it or you don't. Yeah. And some companies will pivot, and there are a bunch of companies that are sort of overnight successes 6 or 7 years later because they pivoted to AI and got it.
Yeah.
And I think that is an interesting opportunity for the right founder and the right team. More often than not, though, I think those companies are going the way of the dodo. And
I really like that point you made, though, is that there are companies today that have taken, let's say, and we have a couple in our portfolio that 4 years of just flat.
Yep.
And then
they find it.
And they find it.
Yep.
And the reason is you built trust with the customer over those 4 years. So when you turned around and sold them a voice agent or a agentic ERP tool or whatever it is, you had enough of trust with them, and now you actually had a product worth paying for.
Yep.
Right. And that's fine, but I think there's a lot of folks that don't have that conversation.
Yeah, and it's, and sometimes, by the way, you can try and the founder's unwilling, and we have those situations where it's sort of like, I've tried, and I've tried, and I've tried, and I've tried, and at a certain point, this is a fool's errand. You're not going to make the pivot, and this is a lost cause, and it's not worth my time, and it's also like, you don't want the conversation from me anymore either. You've made clear to me that we disagree on the importance of changing your model and changing your business.
Yeah.
And that's the sort of, then one of the challenges with this business is like, you're wrong as much as you're right, or you're wrong more than you're right. And particularly at early stage, most of the stuff that we do doesn't turn into big, important businesses.
Yeah.
And you come in with the hope and the dream and the expectation that every company has that shot. But the reality is, particularly in a cycle like this, if you find yourself on the wrong side of a tech shift, you might be toast.
This is starting to veer into therapy territory, but I'm curious because I'm thinking about this a lot too. How do you deal with the psychological piece of it when 70% of the time you're going to be wrong more than twice the times that you're right? Ugh. And yes, we know power law mathematically, you're right enough on the ones that work. But I'm in year 4 of my fund. We have taken more L's than we have maybe
W's or
right.
Totally.
And then from an absolute dollar standpoint, sure, the numbers look good. But in the number of companies that we have had to write off versus the number of companies that I'm like, that's a fund returner, the math is skewed the wrong way.
Yep.
How do you, just as an investor, as a fund builder, manage that psychologically?
Oh, honestly, it's not easy. And look, from when I was an operator, you also had immediate gratification. Like, you do good work and you get rewarded for said good work immediately.
Yeah.
Like, we had a good month, we had a good quarter. Venture just doesn't work that way. These long cycles and these false positives, and it's maddening. It's a maddening business in a lot of ways, and the idea that you're wrong more than you're right.
Yeah.
And by the way, like, the ultimate performance for your fund is really just going to be how right you were in a few of those companies.
Yep.
And the delta is almost surely out of your control and probably a lot of luck. And, it's like, I almost liken it to like being like a major league pitcher or a golfer or one of these sports where you just need to continue to practice and perfect and practice and perfect and hope that over time, like, you get the right bounce and the ball goes the right way or whatever it is. But it is this, just like, to be great at venture is this relentless curiosity, and you have to go and continue to meet so many people and kiss so many frogs, and it just takes a really strong constitution, and I do think this willingness to continue to tweak at the edges and like hone your craft and keep learning, and for all of it, you still may end up like 46th best golfer in the world and just like not winning a major and like being forgotten. It's hard. It's very hard. And I do think that, like, by the way, anytime I hang out with another venture investor who I have any trust with, it's a therapy session.
Yeah, no, I
it's
know.
always
half the reason
session.
I do this podcast, Ben, is got to get that therapy with my friends. If you're a founder, you have been a founder, and you're advising somebody looking at checks from a couple different funds, what should they ask? What should they look for to make sure that their incentive is in line with the fund that they're taking money from?
So I tend to think that the person versus the enterprise is sort of the foundation of the decision that you make. Who am I really going to be working with? Who's investing in me? What kind of trust do I have with them? How good a person do I think they are? What's their reputation? I think going and diligencing that person and that fund secondarily is a critical part of that decision making. I think you do see founders who see a shiny logo, or even, by the way, an investor who has a like great brand and reputation, and they take that for granted and they say, great, I want to work with you, and they don't do the work to understand that person's style and talk to founders who they've worked with, both successes and failures.
Yeah.
Because style matters too. A great investor might not be your great investor. And so I think this is, I don't want to use like the dating analogy romantically, but like you have to get to know the person. You have to sort of know who you're signing up for a relationship with. This is a 10-year relationship, 15-year relationship. Hopefully, it means it worked.
Yeah.
And so, or probably. And so I do think that there is I think founders often don't do enough work to really validate the person that they are working with. It's something that we really push founders to do. When we're doing work on founders, we try to lead the witness, being like, making sure you're making calls about us too. This is a two-way street, and I'm happy to make introductions to you, but I'm also happy for you to do the work. What I don't want is for you to think that Lerer Hippeau is a good brand, or that my reputation precedes me and take my money, but without like doing a little bit more diligence on your side. This is a big decision. And so, and by the way, I don't really want to work with a founder who's flippant about such important decisions.
Spot on. I think that piece, I talk about this a lot on the show, of just doing the off-book references on this investor. If they've been around long enough, even if this is the first time they're launching a fund, like myself, I've been investing for 11 years, but a fund manager for 3 and change, like there's enough of a book on me. Call those people, look at LinkedIn and find those people. And I always appreciate when a founder says, hey, I had a chat with this person about you, and this is what they told me, and I liked what I heard, and by the way, this is also what they said. It's always really valuable to me to go, okay, this is what the market is saying, and generally it's positive when we're able to get into a deal. The other piece that you were kind of touching on there is like spending time with your investor before you take a check from them. How much does that relationship building months ahead of when somebody's coming to you with a raise matter? In today's environment, I feel like it matters less, but I'm curious how you guys think about it.
Historically, I would say that look, we still are doing a lot of really good work, I think, to, even with people that are not long-term known to us, identifying talent early, meeting them, tracking them. Regularly, we are doing deals with someone who we met 6 months prior, 9 months prior, a year prior. Part of that is that we can do both seed and pre-seed. So sometimes we meet people for a friends and family or pre-seed thing. It's not quite right, but we genuinely like them. We think it's interesting. We track, we stay ahead, we can free up the next round, whatever. We also need to be willing to do deals over the transom, in terms of like the transom, meaning there's a really young team that is net new, that is coming to market for the first time, that doesn't have a bunch of deep-seated relationships. We're in the first pass because we've put ourselves from like a brand position or from a hunting position or whatever to like be amongst the first people they meet. But we're going to be in a competitive, no historical relationship situation. We need to actually be able to do those deals in this market because of the talent changes we talked about earlier, more than in past markets. We need to be able to get up to speed and get comfortable with someone early. And a lot of that is the quality of the back channel references that we do. You can phone in the work or you can really do the work. I know that because I've done both in my career. There's a version of really great diligence and there's a version of rushed diligence, and you can actually do great diligence fast, but you have to be willing to shut off everything else for a few days and really commit. This is something I talked to the team about, which is, on the one hand, it's like, oh my God, we're looking at so many deals and things are moving so fast. On the other hand, I try to tell people on the team, like, look, maybe you're going to do 4 deals this year as an investor on the team, or maybe you'll do 5, maybe you'll do 3. You have time. If there's one that maybe is really going to be the one, you have to make time to do to make those last 5 calls. And because I do think at the end of the day, like, this is a very personal relationship and you have to know who you're getting into business with. And admittedly, in the earlier years of our fund, I don't think, more of the rounds were party rounds. We weren't necessarily the sort of like lead dog in all these situations, or like setting the terms, leading the round, owning 10+% of the business. Over time, as we've shifted to that, I really do think it's our responsibility to know who we're getting into business with.
Yeah.
And that means, professionally, that also means personally. I can think of an example recently where, a young founder who I was getting to know, she's a solo founder, 25-year-old, graduate from Penn. And I was like, introduce me to some of your friends from school. Like, I want to talk to your friends, not about business, about you and what it might be like to work with you. And I actually found that to be really valuable in terms of my getting comfort that this was a really high integrity person.
Yeah. Yeah. That evolution you talked about of going from party rounds to, significant ownership, board positions potentially, reserves for follow on, is that a natural evolution of Lerer Hippeau as a fund and just the fund size and under management, or is that where the market is and the elbows are a little bit sharper, so now we got to make sure we get enough ownership? I mean, like, how do you think about that decision?
So if you think about just like sort of the history of the fund, our first few funds were, our first fund was $8.5 million.
Yeah.
Back when, New York's venture scene fit in this room.
It's like 2010, right?
Yeah, exactly.
Yeah.
And everything was a party round, and we were 50s or 100s or 250s or whatever.
Yeah.
Fund 2 was a $20-something million fund a year later, and it was the same. Maybe the 100K became 200K.
Yeah.
Fund 3 was a $30-something million round a year later. Fund 4, which was 2014, is when we had enough history to say, maybe we're not terrible at this. We think New York is on the continued sort of like right trajectory. It also was shifting from being what had been an almost entirely consumer market to a more sort of generalized tech market. Facebook and Google had built big offices here. Engineering talent was really coming to New York. It was sort of like a moment where we said, is this going to remain a hobby, or are we going to get more serious? When we did get more serious, I think we started to look more at fund construction and say, ownership matters. Fund 4 is a $60-something million fund. It's a lot harder to return a $60-something million fund than a $10 million fund.
Yeah.
And for the few companies that end up being really important, we're going to want to own and maintain more of that. We started to reserve more. We started to think a little bit more strategically around how we sort of like deployed that. Fund 5, we moved up to a 10% owner. And at that point, I think we said, we've earned the right not just to be a participant, but we've been in a bunch of situations what we think of and what founders have told us are the sort of like highest value add investors.
Yep.
Like, and that's all true. At the same time, with Fund 5 is a $115 million fund, I think it's very, very, very hard to have a like shotgun approach.
Spray and pray.
Like, I think you end up being more of a index fund and less of like a real like picker or alpha seeker. There are exceptions, and there's folks.
Yeah, Tishat Box and a few others.
There's people who have done a really nice job of doing that. Who and at certain scale, I think that works. I think with every additional dollar you raise, I think that strategy becomes harder and harder. Broadly speaking, sort of the history of venture, which by the way can be thrown up in the air right now because who the hell knows. But like the history of venture suggests that ownership matters, concentration matters, owning bigger pieces of your fund drivers is the way to like the greatest alpha that you can find. And so as our funds have gotten larger, we've had to think more about that construction. We're investing in our ninth fund, which we're now investing in a $200 million fund, which is a lot bigger than our eighth fund, which is 145. And the first thing I did when we closed the $200 million fund is took the whole team into the woods for 3 days and basically said, we're now in a different business.
Yeah.
Incrementally different business. We still only do early stage, but ownership, how are we going to look at the number of shots that we get on goal? How are we going to think about our reserve strategy? It's not just the same playbook, an extra $55 million. If you read, Primax newsletter and see every company in the world feels like it's raising $1 million at a $10 billion valuation, maybe you go, who cares about $45 million? The reality is, when you actually work in these businesses is every dollar matters. To drive great returns, you need to be meticulous about how you deploy that money and thoughtful about construction. And so our model does dictate that we need to own more. I will say our peer set has also grown with us.
Yes.
And so the people I grew up in this business who do seed exclusively and started with 10s or 20s or 30s also have multi-$100 million funds if they haven't been washed out of the space.
Yeah.
And the folks that are still doing it have all learned the same lesson we've learned, which is that ownership matters. And now where we used to be able to partner and say, hey, let's do it 50-50, we'll each take 10%. Everybody wants a little more than 10%, less collaboration, yes, sharper elbows, although with a smile sometimes. And I do think these deals are more winner take all,
Yeah.
where a founder goes, you're who I want to work with. Something that like we have to contend with. It pushes me to be earlier. It's pushed me to, continue to scale our team for more top of funnel, like better market coverage, more opportunities, because there are plenty of things that we are really interested in, but round dynamics
Totally
make it impossible. I want to go back to something that you mentioned earlier, which was that idea that like your fund constraint around there's people doing $35 million post on pre-rev. And I had lunch with somebody yesterday, a great sort of like longtime New York based VC. And, he was talking about the idea that value investing in venture specifically, like doesn't really work or doesn't have like a great history. And at the same time, he and I were lamenting the fact that like deals are expensive.
Yeah.
And, he was saying he thinks that like generally good founders know their worth.
Yeah.
And in this market with a lot of money available, like that worth has gone up. And if you're playing a value game, you're probably not getting access to the best stuff. Not without exception.
No,
I think the idea is like there are those like proprietary relationships.
No, you have to go into market. You have to go to the Midwest, right? I've done deals in Austin and Scottsdale and a bunch of places where I'm like, this is a great company doing $1 million in revenue. If it was based in Silicon Valley, it'd be priced at 3x.
Yep.
Right.
I think there's versions of that. The hard thing about this market today is I don't think the right thing is to be maniacally heat-seeking and just following teams that look like they're out of central casting and that are in sort of, obviously venture scale spaces, building AI, catnip for Sand Hill Road, and like you're going to get your quick mark, but you're going to pay a premium dollar coming in. And like, are there places to play there? Absolutely. And are there times where you need to go and pay up and spend for various situations? I think the answer is yes. But I think if that's your whole strategy, it puts a lot more pressure on, boy, you better be right.
That's right.
And I think the flip side is if you are a value-seeking early-stage VC, you need to get ready for a lot of L's because you're going to have a bunch of businesses that are just not going to be able to raise follow-on capital, even if they're good teams and they're doing well, because they don't fit the sort of whatever this image is that the sort of venture world has matriculated towards.
As somebody who considers myself in the second bucket, because that's what I had found success in previously and how we built the model for this one, and I find myself in an environment where, again, I have a peer group that is optimizing for those quick marks. The challenge with that second bucket, Ben, is that LPs see everything. And they go, he's got a fund marked up, 4x. Now, who cares what the entry price was because happened to get into the hot thing that's now, a unicorn in 3 weeks. And you're in something that you own, a significant percent of, but it's not growing that quickly, right? So you're right. I think, the best advice that I got when I was starting out my fund is like, you have to have a tolerance for pain. And I'll credit myself with that, which I have a almost cockroach-like ability to just stick around long enough for something to work, right? But at the same time, it does require LP management, founder management, and you have to sort of stay the course, because the moment you go from this disciplined bucket into the one where you're heat-seeking, Micah Rosenblum has a great post called Heat Seekers or Truffle Hunters.
Yep, I know exactly what you're talking about.
And it's such a perfect distillation of the two kinds of people I meet in venture. And I have for a decade been a truffle hunter, and I find myself in a world of heat seekers. How do you advise the young investors at your firm? What's the makeup you're looking for?
Interestingly, I do think that like an investor is either a heat seeker or a truffle hunter. I have people on my team who are both. And so I do think about this as this is the operator in me. Or get back to a sports analogy.
Yeah.
You got your like on base percentage guy and you got your home run hitter or whatever.
Yeah.
Like we have and that's one of the advantages of having done this for a long time and having a bigger fund is having the resources to have a bigger team. I have people on my team that are heat seekers. Yeah. They just are. And funny enough, there's one particular person on the team who I will sit in a meeting with him. There'll be a pitch, and I know in 20 seconds, I can just see him immediately tune out when it's not that kind of team.
It hasn't fit the rubric that he's looking for.
He's looking for a certain thing. And I know what the thing is. And by the way, I also know if we're in the room and I see it, and then he's, like leaning in and like sits up differently. And like you see the animal unleash in terms of he's like, I'm sitting across the table from a prize fighter and like, let's go. And I think that like for us, we are neither a heat-seeking fund nor are we a value-seeking fund. I think we have people that have more of that sort of like West Coast investing mentality and more of that East Coast investing mentality. And we, when we sort of like make our stew out of all these ingredients, we talk about being talent seeking. And the idea is like talent comes in different formats. Because we are purist early stage, we can, again, sort of first principle boil down to, yes, this person doesn't look like they're not obvious, but do they have qualities that lead us to believe that there is massive potential?
Yeah.
Versus what we want to avoid is, this is going to be a good business. I don't care about this. And by the way, I've made this mistake. This is one of the like, hey, I've done this for 15 years. And through all the like learnings, one of the really weird long-term learnings is I'm not interested in investing in good businesses. And I invested in a lot of good businesses, but good businesses don't make venture work. Venture requires the power law, and the power law means the potential for a great business. And particularly in consumer, I fell into this trap where I backed too many things in not really venture scale categories that were going to be good businesses and they were going to grow nicely and they would be predictable and there would be a market for them. And there's a high likelihood of a 3 to 5x or a 3 to 8x or whatever, and a much lower loss ratio, but also a much lower percentage of really outsized returns.
Grand slams.
And by the way, the joke is like, we've also hit our version of grand slams with companies that like from the outside probably didn't look obvious, but the talent had that sort of star quality potential. And I think we're trying not to play the game of doing like falling into the venture bias, but also I'm not willing to go and throw my arms up and say all these expensive deals with all these things is madness. The model can't work, because we have historically seen companies where we passed because we knew it was an extraordinary team, but we passed on price and came to regret it.
Yeah, totally.
And by, again, this is like back to psychology. Oh, kill me. Like you can make the mistake once and then make the same mistake again, or make a different mistake for the same reason, or
you learn the wrong lesson, right? You sort of go, it worked in this,
or you
so
think
it
it's
must
a lesson.
Work in that, or you think it's a lesson.
You think it's a lesson and it's not a lesson. I was on a panel recently and with early stage investors, like blue chip folks, and someone in the audience asked a question, and I was moderating, so I didn't have to actually have a perspective, which was nice. And they asked a question about how to invest in AI companies right now.
Sure.
And the first guy said, listen, there's no moat in these businesses, or very little moat. You can vibe code your way to whatever. Everything's going to get built really quickly. The only advantage is a distribution advantage. I want to invest in people that have really unfair distro or sales advantages, or knowledge of an industry, relationships, etc. And that made a strong case for why they're investing in founders that are like going to win at distro. And then the other incredibly smart, astute, also high performing investor right next to him said, we do the exact opposite of that. And we are still only interested in businesses that we believe have a tech moat. And while it is harder to come by those, and maybe we need to move into tech bio, or moving into areas of defense, or moving into areas of robotics, or the reality is we think that those distro advantages are short-lived, can be hired for, and are not important, and we are still only searching for tech outlying moat.
Right.
And it was just such an interesting moment to sit with two like
Successful.
very successful, like, you know, sort of like quote unquote world-class folks who would look at the same market and be diametrically opposed to one another in terms of what they think is important
Yeah.
for winning. Again, I don't know that like that wouldn't have been the case in any other cycle, that there weren't people on either side of cloud or mobile in some way, shape, or form, or like, you know, ways to win. But it was just, it was a funny moment for me to sit there and go, wow, nobody
knows.
This is the Wild West.
For most of our LPs, and I say this on the show all the time, we have 88 LPs. I call them the crazy 88 because they took a chance on us when they really didn't have to. They're all individuals. They're all former founders. They saw the value that marketing and PR had for them, and they said, wow, you're going to build a fund that goes and does this for founders, and you're going to cut them a check too, so you're long-term aligned with them. I love that. We're going to come and back you.
The right kind of LPs, whether those are individuals or you know, professional institutions, they, more than even an individual company that gets written off, they understand that like even extraordinary funds have bad cycles,
yeah,
and miss a window or don't get lucky on a power law company, or, you know, like the ball gets fumbled or whatever it is. And so I do think that like that's why I come back to the idea of always looking at your model and iterating on your model. The best LPs are going to be most interested in you being self-aware and hands on the wheel and always trying to get better, and not just executing a strategy because it's what you said you would execute. Think about you with a portfolio company.
Yeah.
There's a portfolio company who says, hey, this is what I'm going to go do. We're going to go sell B2B. We're going to go sell, you know, it's going to be a PLG sales motion and blah, 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 blah. And 2 years later, they're like, we've been living in the market. We've been feeling the market. This isn't the right sales motion. We don't have the right person here. We need to rethink about this. If they're communicative and clear, you know, learning from experience and bobbing and weaving, you ultimately develop more respect and trust for that founder.
Yeah.
Versus someone who just like slams their head against the wall and does the same thing because it's what they said they were going to do.
Yeah.
And so I think it's important, again, you need to have like the best quality or a high quality of LP. But if you have that and you are a clear communicator, people appreciate that like desire to get better, and I think we'll be flexible. And I don't mean to talk to you. I'm talking to
please,
like
talk
the
to
world.
me.
I talk to myself. Again, we're in therapy. But like people will appreciate that you're allowed to tweak the formula,
Yeah.
maybe significantly, and it doesn't have to be because the formula is not working. It doesn't have to be like an acknowledgement that like what you're doing isn't right, but it is an acknowledgement that like the world continues to change and you got to change with it.
Yeah. That's a fantastic place to leave it, Ben. I could do this for another hour with you. I'll send you a therapy bill.
Deal. Thank you. Well, am I paying or am I
don't know.
I being compensated?
That's good. That's a good
okay.
point. We might have to do it in trade. Listen, I've respected what you have been building at Lerer Hippeau for a long time. Obviously, have known you for many, many years, and so just a thrill to have you on to get to talk through these things. And you know, again, as I told you last night, like we're in an interesting point of our fund where we're starting to think about the future, the back third of how we invest this capital, and to see somebody who's been doing it and building an enduring advantage over 15 years, it's just been really fun for me. So if nobody listens to the show, I know they will, but if nobody listens, this has been incredibly valuable for at least one person.
Well, thank you, and it'd be fun to do some deals.
Yeah, would love that.
Let's go.
Thank you, Ben.